Self-employed borrowers often feel that lending outcomes don't reflect the strength of their business. The numbers make sense to them. Cash flow feels reliable. The business is profitable. But lenders aren't assessing how the business feels to operate. They're assessing how predictable that income looks inside a risk model. That difference explains most self-employed lending outcomes. From a lender's perspective, self-employed income is not just income. It's income with variability. So the assessment is not about how well the business is performing right now. It's about how confidently that income can be relied on over time, including under stress. That lens drives everything else in the assessment. The central concept in self-managed assessment is normalization. Lenders are not asking, what did you earn this year? They're asking what income level appears stable and repeatable. That usually involves averaging income across years, smoothing volatility, excluding anything that looks irregular or one-off. A strong recent year does not automatically help. A weaker year doesn't automatically hurt. What matters is the pattern. The system is looking for stability, not upside. Self-employed income is assessed differently depending on structure. Company directors, sole traders, and partnerships are not interchangeable. Some income is drawn from taxable profit, some from salary and dividends, some from distributions. In every case, lenders are cautious about assuming that business income is freely available for personal loan repayments. Income existing inside a business does not automatically translate into assessable income for lending. This is where outcomes often tighten. Business expenses are reviewed conservatively. Add-backs are assessed for consistency, sustainability, and relevance to ongoing trading. If an expense looks discretionary, temporary, or easily removed in a downturn, it's often excluded. The objective is not to maximize borrowing capacity, it's to minimize uncertainty. Recent change increases risk. Changes to structure, ownership, industry, or income consistency. Even if the business is stronger now, recent change reduces how confidently income can be projected. That's why timing matters more for self-employed borrowers than many expect. Different lenders tolerate different levels of variability. Some are comfortable with shorter trading histories, income growth, or specific industries. Others are not. So differing outcomes usually reflect differences in risk appetite, not differences in business quality. A no is often a system declining variability, not a judgment on performance. For self-employed borrowers, borrowing capacity is rarely fixed. It depends on how income is normalized, which lender models is applied, and when the assessment occurs. Understanding that reframes the question. Not, why doesn't this reflect my business? But how is the system measuring stability? Self-employed income is assessed cautiously, not intuitively. It's processed through models designed to prioritize predictability over potential. That's the framework producing the outcome.